Sri Lanka's banking sector, can it break off from the current stalemate? How fast that they could grow their loan books from the current state of impasse?
So this year we are expecting a significant growth compared to that demand, tripling it to 15% growth. So this year we are targeting somewhere in the range of 750 billion to 800 billion of
in new credit.
New credit. So specifically private sector credit.
How the earnings behave? Will they be able to return to the former glory days of registering double-digit earnings as they have used to? Will they be able to arrest the rising NPLs which rose to multi-year highs last year?
Actually, what we are expecting is the NPL ratios to start to peak at this moment of time and start coming down gradually.
Will the banks stay hungry for capital as they have been in the recent past? Will the government moot industry consolidation again? Do you want to push towards industry consolidation again?
Let me look at it again, because now 5 years have gone by, the conditions may be different. I think there's still a need for that, but the need will have to be now dealt with in a different way. We cannot just bring the same model of 5 years ago and then have the model now.
It's all coming up in this episode of the BizWatch. If there is a single sector where one cannot avoid or ignore when discussing about the economy of a country, is that the banking sector. It's too big a sector and it's too good a sector to be overlooked. For instance, Sri Lanka's banking sector is 3/4 or 75% of the size of its entire financial system, and its size is 40% of the entire market capitalization of all the listed entities in the Colombo Stock Exchange. So, how can we not discuss about the implications of the banking sector on the entire economy and a business which has implications on our daily lives? Before we look in front, it's always better to take a stock of what happened during the last few years. In hindsight, Sri Lanka's banking sector underwent some rough patch during the last few years, particularly starting from 2017. For instance, after an instant and unsustainably high growth in 2015 and 2016, Sri Lanka's banking sector's growth came to a standstill after the central bank started raising the interest rates starting from 2016 until the end of 2018. And further, the banking sector took a hit from the continuously increase in taxes, which resulted in a slowdown in the entire economy. For instance, if you look at this chart, it clearly shows Sri Lanka's banking sector growth or the private sector credit growth, or in other words, the loans given by the entire banking sector have behaved in lockstep with the growth of the economy. For instance, during the first 11 months of last year, the entire private credit growth of the banking sector came in at a very dismal level of 2.5%. with only the meaningful growth only seen in November after the central bank imposed lending rate caps in September that year. If you look at this chart, you can clearly see there's a clear increase in the credit in November month, which in absolute terms of about 47 billion rupees. But the industry expects the private sector credit growth to end the year with a total growth of 4 to 5% in 2019, because December is typically considered as a month which has high economic activity, which actually triggers a higher demand for loans. Meanwhile, the banking sector asset quality fell sharply during the last 3 years. Asset quality, or in other words, the non-performing loans in the banking sector, fell to a high of 4.9% by the end of October 2019 from a low of 1.5% at the end of 2017. You can see from this chart how the NPL ratio, or the non-performing loan ratio, has behaved since 2017 until the end of last year. Generally, the banking sector is considered as a resilient sector in the country, especially for earnings. But in 2019, it showed some stress levels. For instance, the banking sector earnings narrowed sharply in certain instances, and some of the capital issues of the banking sector was shunned by the investors of the banking sector, to the surprise of many. But would the new beginning with easing rates and sweeping tax cuts which were given to the banking sector provide the much needed impetus to the banking sector in 2020 to make a strong return?
So this year we are expecting a significant growth compared to that demand, tripling it to 15% growth. So this year we are targeting somewhere in the range of 750 billion to 800 billion of
in new credit.
New credit. So specifically private sector credit.
According to the other banking sector analysts the TheBizWatch spoke to, they are also of the strong belief that there will be a strong rebound in the private sector credit growth, driven mainly by the consumption-driven credit. This is because Sri Lanka is typically a consumption-driven economy, a phenomenon which may not be very healthy. In any case, the very first thing that happened when the interest rate is in Sri Lankan economy is that the people will borrow more for their consumption, which means the banks will see a strong rebound for demand for credit in areas of personal loans, credit cards, leases, house mortgages, and so on and so forth. The banking sector analysts also say that the banking sector would return to their typical double-digit growth in their earnings, especially due to the strong rebound in the credit growth and the additional tailwind that they might receive from the recent tax cuts. However, will the banks turn more conservative and risk-averse in the face of the size of the loan moratorium and the credit support scheme implemented by the government?
We talked about the tax concessions that were given by the government, like the NBT tax concessions. We feel that that is likely to offset by the moratorium given by the government on the SME companies. We feel that there could be some sort of a they'll be more conservative in lending if they because of this moratorium. Now we've had number of interviews with the bank over the last couple of weeks as well. So with this moratorium, what they've actually the banks have started is more or less looking at more collateralized loans going forward. So what happens is banks become a bit more risk averse with this situation, and also their NPL situation improvement will have a issue, and they will have difficulty in finding out whether to provide expanded credit facilities to this the existing loans and the businesses.
On the contrary to the wider expectations, Moody's Investors Services last week in a special note said the proposed debt moratorium and the credit support scheme for the SMEs would be credit negative for the banking sector and is unlikely to support the economic recovery. Well, quite a harsh assessment of the potential influence or the impact from the credit support scheme on the economy and the sector. The assessment is based on the premise that the credit support scheme will risk increasing SMEs' risk appetite and relaxing attitude towards the debt repayment by the SMEs. This, they said, in turn will undermine the bank's asset quality and constrain sovereign credit profile. Well, they're not entirely wrong, because a manager of a bank, a leading bank, recently told me that there are many bad SMEs who are waiting to make use of the moratorium. But many good ones may not apply because they will find ways and means to service their facilities going forward. Will the banks stay ever more hungry for capital? Or how the new classification of systematically important banks and non-systematically important banks by the central banks would support the bank's growth and the earnings going forward? How about the small lenders who are still below the regulatory minimum capital levels? Will they be pushed for consolidation? In the recent past, banks have been the front runners in raising capital, both equity and debt, because they were raising to stay on top of the higher capital requirements stipulated by the central bank and the Basel III regulations. However, is there a pressing need for them to stay the course? during this year as well, because they have hardly seen any growth in their risk-weighted assets or the loans, in other words, in 2019. Further, the central bank also revised their classification of the systematically important banks and the systematically not so important banks, which gave them further leeway to grow their asset books or to grow their loan books with the existing amount of capital.
On top of these things, there's another added benefit given to the banks, which is the capital adequacy ratios has been relaxed. So with that, that also gives some leeway for the banks to go out there
To
and
expand their risk-weighted assets.
Yes,
with the amount of capital that they already have.
Exactly.
Will there be sector consolidation going forward, which was halted by the previous regime? I asked Ajith Nivard Cabraal, the senior economic advisor to the Prime Minister and a key member of the economic management team of the current administration.
The banking and the finance sector underwent some very serious reforms in 2014, and we were halfway through. If you remember, we had a consolidation program, and that was thought through very carefully, and that could have made a huge difference in the entire landscape of the country. Well, somebody said that it was Cabraal's idea. Well, actually it was not mine. It was a idea that was thought through at the central bank, which I thought was excellent, which we supported. But I think it was on political grounds, they just shelved it. And today we have to again go back to the deficiencies that have occurred as a result of that. So,
do you want to push towards industry consolidation again?
Let me look at it again, because now 5 years have gone by, the conditions may be different. I think there is still a need for that, but the need will have to be now dealt with in a different way. We cannot just bring the same model of 5 years ago and then have the model now. So we will have to reflect on the changes that have occurred and the situation that we are in today, and if it is the right decision to have this arrangement of consolidation coming back, well, so be it, and we will have to promote that and support that. But at the same time, we will keep an open eye.
So this is it from this edition of the BizWatch. Do join us next week from the very latest from business, finance and economics.